All right, so those are both the regulators sounding off a lot of concern on what's going on in the F&O market. Now, we got reactions from a whole host of market participants, experts through the weekend on this because this matter has stirred up a massive debate on social media. People are really asking the question that is the increase in F&O volumes really such a big concern? Should regulators be so concerned as long as the markets are behaving in an orderly fashion? However, a lot of participants from the mutual fund world definitely are concerned, and those comments are on your screen. Nilesh of Kotak AMC says that the SEBI chairperson is absolutely right in stating that F&O activity is both a micro as well as a macro issue. From a macro point, there are issue of savers becoming speculators rather than investors. And from a micro point of view, there is a need to create a level playing field between local and global participants in the F&O market. Basically, global participants which have access to big algorithms, high-frequency trading versus retail, which perhaps doesn't have access to that level of technology to trade in the F&O market. That's Nilesh's point of view. Look at Swaroop Mohanty of Mirai. He's saying the number of people who have started return chasing is scary. While the market capitalization and the number of available stocks and free float seems to have widened, what does not change is the liquidity status of the market. Everything is okay until inflows are higher than outflows. The day that changes, it can go in a very wrong direction. We'll keep playing more and more of these reactions that we've gotten some very interesting comments coming in and keep looking at that screen for more. We also, of course, have a live screen for more. We also, of course, have a live panel to take this issue forward. Jimeet Modi, founder and CEO at Samco Securities, is with us. We'll also have some other guests joining in. I think we've got Rajesh Baheti as well. Rajesh, welcome to this conversation. And Deepak Shenoy of Capitalmind. Gentlemen, I don't know if you saw your Twitter feeds or social media feeds over the weekend, but I think the regulators really set a whole debate in motion. Let me come to you first, Jimeet. I think the issue here is this is happening before the budget, remember. There's a lot of speculation about whether there's going to be a change in STT, whether tax should be used as a policy to keep retail away. Now, I don't know how you distinguish between retail paying STT and institutions paying STT, but your thoughts on the matter?
So, first of all, thank you so much for having me on the show, Surbi. If I was to sort of look at the movement in options trading, and I think bulk of the challenge with the and the comments that the regulators have sort of referred to comes in the option segment. I think that is where the concern lies. And it's important to understand that this shift in the past 3-4 years that has happened, where options volume has increased, is not because of some random increase in speculative behavior. I think a lot of it has been the first order and second order effect of regulatory changes that have happened in the past. There was a new margining framework in 2020. There were peak margin regulations that were introduced in 2020-21. And those regulations resulted in an indirect move of people moving from the future segment to the option segment. That's point number one. The second thing is, do I believe that this is a macro issue? So, if you look at the data and the data where how many people actually participate in the options market on a monthly basis, that number is about 40 to 45 lakh on a monthly basis. So 40 to 45 lakh unique PANs participate trading in index options or stock options on a monthly basis. And this is based on NSE data. Now, is the participation of 40 to 45 lakh individuals out of a population of 140 crore people a macro issue? I think probably to some extent the fact that there has been excessive speculation, yes, but it's not that this is a issue that is impacting crores of households in the country. So this is a small segment of the market which is indulging in very, very high activity. And obviously the regulator is right to look at seeing which are the manner in which they can avoid this excessive speculation. But the fact remains that this is a small micro market of 40-50 lakh people engaging in this business activity every month.
Got it. Rajesh, come in on this. Do you think it's too early to call it a macro issue that Jimeet was pointing out? And secondly, what could be the steps? Because collectively, increasingly, we are hearing all the regulators, whether it's the government, whether it's the RBI, SEBI, all of them appear to be cautioning, raising the red flag on this. So what might come out? And especially in the budget, should we expect anything?
So I think it's fair to accept that SEBI and the government is seeing a situation which they don't like. It's something that we need to recognize as an industry. But what's more important is that if you have a problem statement that says that it's the lowest rung of retail or the large retail participation that is bothering you, the steps you should take should be targeted at preventing that portion of the retail segment that you think shouldn't be trading in the F&O segment to prevent them from trading, rather than put some kind of curbs that will kind of dampen the overall market activity and take us back 5, 10 years, 15 years into the past and really damage the entire industry as well as the MIIs. To that, I would have said, and I've said that before, that the best way to target the retail or the lowest rung of retail is two ways. Either put some kind of course, market lot adjustment to 20 to 25 lakhs would be one of the key variables there that would prevent the smallest rung of retail from participating, because whether you're buying options or selling options, I think the cost of margins would go up. The other way to look at it is set a minimum capital adequacy criteria of 10 lakh rupees as margin, irrespective of whether you're buying options or selling options, that you've got to have a balance of 10 lakhs with the broker in order to trade the market, F&O market. You set a criteria like that, I think the lowest rung of retail will go out of the market. Look at the number of UCCs that are trading pre these changes versus post these changes. And if you think you've achieved your end in terms of the number of people accessing the market rather than market volumes, then I think you'll have achieved your end. I think looking at market volumes is not the right way, because we've had technological advances from which market volumes have gone up. More importantly, the important variable to look at is the number of UCCs trading in the market.
Fair enough, and I think that's the point that Jimeet also made, because the actual number of PAN holders, he said, as per NSE data, is about 40 to 45 lakhs. So is that really such a huge number to get worried about? It's a smaller set of people indulging in a lot of speculation. That's his point. But let me bring in Deepak as well. Deepak, now we'll get to the more in-depth, the broader picture, moral debate on the regulator's role in just a bit. But before that, for a moment, let's admit that this is a problem, because that's what a lot of industry participants are also saying. So how should one fix it? Rajesh is saying do it via change in lot sizes, not necessarily maybe tax. Do you concur?
I don't think, see, if people lose money, they don't pay tax. So I don't think that's a deterrent. So in the sense that you will look at the lot size, I like the lot size idea very much, because when, SEBI introduced lot sizes, or I think NSE introduced lot sizes, the argument was roughly 100 shares in the US would constitute a lot. Roughly the average stock price that was originally the US market was designed for was $40 a share. So it was $40 into $100, $4,000, 50 rupees to a dollar roughly. So 2 lakh rupees was our lot size. Our GDP has gone up 10x since 2003 or 2002. And then, so 22 lakhs should automatically have become 20 lakhs, but it has become only 5. And secondly, the US average stock price is now probably $200 to $300. So a similar argument would lead to roughly $20,000 equivalent as a lot size that you would have in India, which is about 16 to 17 lakhs. So I think having a 20 lakh or 25 lakh lot size would be appropriate, given the relatively higher volatility in the segment, and you need the sell side of the options at least to be a lot more financially viable. The buy side is, just limited by the amount they put in. But the other arguments are also sound, in the sense of, I would say, even reduce the number of option expiries by, instead of one every day, to maybe 2 a week, one for each exchange, which is probably more viable, because then you reduce that, the footprint of unbridled speculation. Speculation is not bad. It's a good thing. I think even it's a business. A lot of people in this business have come out from next to zero and made a lot of money in the F&O business by doing so. It is not, therefore, akin to a casino, where the casino keeps almost all of the profits made here. Here it is actually spread out between a lot of people, and a lot of people can come in from relatively humble backgrounds and still make a lot of money. So I don't think it's worthwhile to ban it. You should just make it a little bit higher in terms of raising the bar in terms of entry, so that some of the least, the lowest end is raised by a little bit, so that you have to spend at least 50,000-60,000 rupees just to participate, and that will deter a lot of the smaller players here.
Got that. Deepak, we've been running your court play too, where you've said the speculation in F&O does not cause a banking problem. Could you explain that a little bit?
Yes, so let me run this by, if you look at it, no matter how, if I take my money out of my bank account and use it on F&O, I give it to my broker who's got a bank account. That broker will upstream it to the clearing corporation, which has a bank account. All this money is invested again in some kind of banking asset, right? So it's still part of the banking system. So there's no structural liquidity problem at all. The RBI governor actually said it in a different way. And he said, there's no liquidity problem per se, but you have a problem at a single bank level where you depend so much on CASA, your current account, saving account, where you give no interest. And therefore, people get smarter and say, listen, let me put it in money market funds. Let money market funds invest in wholesale deposits for banks, which come at 7% rather than the CASA, which comes at either 0 or 4%. So the cost of your funds is going to go up. And if you keep depending on CASA, you will have a liquidity problem at an individual bank level. But the banking system is not going to see a liquidity crisis at all. And it doesn't make any sense for a banking liquidity crisis to be created by something moving from one bank account to another bank account within the banking system. Liquidity crisis either comes from money going out of the banking system, either by the government collecting too many taxes and keeping the money in and not spending it, or people turning their money into cash, which moves money out of the banking system. It doesn't happen this way. Speculation will not change the way bank liquidity is as a systemic at a systemic level. But individual banks have been very lazy. They don't raise deposit rates and they crib that people don't put deposits in them. So I think this is not a banking liquidity problem at all.
We hope it stays that way, though that's a different debate altogether on, if it were as simple as just raising interest rates and getting a lot of deposits. I don't think any of the banks would be complaining. That's a different debate. Gentlemen, I think we need to do a longer one on this. We're constrained by a lot of earnings also coming in today and all the pre-budget stuff. We promised to get you back to answer the bigger sort of moral issue around this. Should regulators really have a role as long as the market is orderly? Thank you so much for joining in. As we take a break, I just want to pull up that quote plate from Ajay Bagga, who answers that question. Maybe we'll have him on the panel. He says, and I quote, regulators' mandate is market stability and integrity and, yes, investor protection from Ponzi schemes. But their mandate is not investor returns protection. Then you will always have infantile behavior-oriented investors who take credit for bull market returns and blame regulators for losses in corrections. I feel this is a regulatory overreach. This is a big debate. It isn't ending now. We'll have the panel back here and maybe Ajay as well to take it forward. Right now, a quick break. More on the markets in just a bit.